Hey everyone, welcome back to Corporate Decoder. Today we're diving into NETGEAR's latest quarterly report, and let me tell you, things aren't exactly screaming smooth sailing. Imagine your home Wi-Fi suddenly deciding to take a vacation. That's kind of the vibe we're getting from this report. NETGEAR is trying to keep everything connected, but there are a few glitches before we jump in if you like getting the real story from corporate filings. Subscribe and join our Discord community linked below where we chat about this stuff all the time. This is their 10Q form, basically a quarterly checkup to show the Securities and Exchange Commission, or SEC, how they're doing. We'll look at the key numbers, what they mean, and what's going on behind the scenes. First, let's talk money. Their net revenue, the total sales after returns and discounts, is about $162 million. That sounds like a lot, but it's actually a slight decrease compared to last year when they made about 164 times 6 million. Think of it as losing a few customers along the way. Now, the good news is their gross profit, which is what's left after subtracting the cost of making their products, is up. It's at $56.30 million compared to $48.2 million last year. So they're making more money on each product they sell, even though they're not selling as much overall. This means they're focusing on making more expensive products that give them better margins. But here's where things get a little tricky. They've cut back on research and development, spending about $18.3 million last year. That's like slowing down the engine that powers new ideas, but they think it's a trade-off to improve earnings this year. They also spent less on sales and marketing, about $28 million versus $30.5 million. You can think of sales and marketing expenses as the money they use to generate demand for their products and create advertisements. So while they're saving money here and there, it's at the expense of sales and product development. Ultimately, NETGEAR still ended up with a net loss, meaning they spent more money than they made. However, this loss is smaller than last year's, a loss of $6 million compared to 18 times $6 million the previous year. The smaller loss comes because the gross margin on the sales they did make increased as much as sales decreased. That translates to a loss of $21 per share, which is better than last year's $0.63 loss per share. So while they're still in the red, they're losing less money per share than before. It's also worth mentioning that their share count is slightly different, about 28.7 million now compared to 29.4 million last year. This is mainly because they bought back some of their shares, a way to return value to investors, even when the company is not doing well. This generally increases earnings per share, EPS, or decreases earnings per share. EPS or decreases loss per share. Looking at the cash flow statements, their cash and cash equivalents decreased by $16.6 million during the 3 months ended, showing they are using their reserves to fund current operations. The report divides NETGEAR into different segments, so it would be amiss of us not to talk about it. They are NETGEAR for Business, Home Networking, and Mobile. It looks like NETGEAR for Business is a bright spot with revenue going up, while Home Networking and Mobile are struggling. They had some restructuring and other charges for $4.7 million, much more than the $1 million in the prior year period, due to firing employees and other costs. This can boost profitability in the long term, but comes at a short-term cost. Let's peek at future revenue. They have a backlog or future work to complete with signed agreements of about $68.7 million, which is down from their balance last year. Now, let's take a look at what the key executives think about this report. You see, sometimes what the company says to investors doesn't reflect what is really going on. This is what their leaders think are important. Time to address the elephant in the room, risk factors. These are the things that could potentially derail their plans. A couple of points are noteworthy here. New regulations on trade policy, import or export. Reliance on just a few major customers, which can be precarious. Basically, they are concerned about the government disrupting their markets and sales. Then there are the legal battles. They face a lot of potential litigation, which is not an unusual problem, but could lead to liability that affects their financial outcomes. After that, market risk is also an area they are concerned about. Things like stock value and interest rates, and what they might do to the business in the future. Finally, the top dogs, the CEO and CFO, are saying that the numbers are fine and that they're responsible, that the numbers they are presenting are according to required guidelines. This is standard, but it's also a way to be held accountable to the report and its filings. Alright, now let's put it all together. NETGEAR seems to be trying to turn things around, focusing on profitability rather than just chasing growth. Their shift towards higher margin business products is a smart move, but cutting back on innovation and marketing might hurt them in the long run. In summary, you can only cut so much before it's all bone. Also keep in mind that so many challenges are out of their control. Trade policy, economic climate. They will have to wait like everyone else and weather the storm. What's your take on NETGEAR's moves? Are they playing it smart or cutting corners? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.